Hello and welcome to AccountingSuite Academy. In this video, we'll explore the basics of accounting, step by step, in a simple and practical way. Even if you've never studied accounting before, by the end of this video, the core ideas will be clear. Why do we even need accounting? At its core, accounting answers the following key questions. What does the business own? What does the business owe? Is the business making a profit or a loss? Where does cash go? Where does cash come from? Accounting is the language of business. Every company, small or large, relies on accounting to track money, control expenses, measure performance, pay taxes correctly, and make strategic decisions. Without accounting, a business operates blindly. Investors, banks, managers, and governments all trust accounting data. That's why accounting must be accurate, transparent, and consistent. In business, every transaction always has two sides. When a company buys something, it receives a resource, but it also gives something in return. For example, when a company buys goods, it receives inventory, but it loses money. One resource increases, another decreases. This is how business works. Nothing appears from nowhere and nothing disappears without a reason. To connect these two sides of every transaction, accounting uses a system called double entry bookkeeping. Double entry means that every business event is recorded in at least two places in the accounting system. One entry shows where the value went, and another shows where the value came from. Because of this structure, the accounting system always stays balanced. To record transactions in the double entry system, accounting uses two directions: debit and credit. Debit simply means the left side of an account, and credit means the right side of an account. Debit and credit do not mean positive and negative. They are simply directions used to record financial changes. To understand them, we need to look at how business resources move. Every business transaction represents a movement of value. Resources always come from somewhere and go somewhere else. For example, if a company buys inventory for cash, the company receives inventory and the company pays cash. Inventory increases while cash decreases. Accounting records both sides of this movement. This is why we need two entries in every transaction. To make the system work, accounting divides accounts into two groups: normal debit accounts and normal credit accounts. These groups reflect the role each account plays in the business. Normal debit accounts represent where resources go. These accounts increase on the debit side. They include assets and expenses. Assets represent resources owned by the company, such as cash, inventory, equipment, and buildings. When the company acquires new resources, assets increase and we record this on the debit side. Expenses also increase on the debit side because they represent resources consumed while running the business. For example, paying salaries, paying rent, or purchasing materials. These costs reduce the company's profit and therefore reduce equity. Normal credit accounts represent where resources come from. These accounts increase on the credit side. They include liabilities, equity, and income. Liabilities represent money owed to external parties, such as bank loans or supplier payables. Equity represents the owner's investment in the business. Income represents value created by the company through its operations. For example, when the company sells goods or services, it generates revenue. That revenue increases the owner's equity in the business. Because equity increases on the credit side, income also increases on the credit side. A simple way to remember this is debit represents the destination of resources, and credit represents the source of resources. Resources enter the business through credit accounts and are used through debit accounts. Let's look at a simple example. A company buys inventory for 1,000 euros in cash. Two things happen. Inventory increases and cash decreases. The accounting entry would be the following: debit inventory, 1,000 euros. Credit cash, 1,000 euros. Inventory increases because the company received goods. Cash decreases because the company paid for them. The total debits equal the total credits and the system stays balanced. An accounting account is a record that tracks changes in a specific asset, liability, equity item, income, or expense. Each account accumulates information about one financial element of the business. Examples include cash, inventory, accounts receivable, sales revenue, and rent expense. When a transaction occurs, accountants record it using a journal entry. A journal entry includes the accounts affected, the debit amount, the credit amount, and a description of the transaction. If a company buys inventory for 1,000 euros in cash, the journal entry would be the following. Debit inventory, 1,000 euros. Credit cash, 1,000 euros. Each journal entry reflects both sides of the transaction and keeps the accounting system balanced. To organize all accounts in a structured way, companies use a chart of accounts. The chart of accounts is a structured list of all accounts used in the accounting system. It provides the architecture of financial information inside the company. Most accounting systems organize accounts into 5 main categories: assets, liabilities, equity, income, and expenses. In practice, each account usually has a number. For example, a company may use account numbers like these: account 10,000, cash, account 12,000, accounts receivable, account 13,000, inventory, account 20,000, accounts payable, account 40,000, sales revenue, account 50,000, operating expenses. This numbering structure helps accounting software organize transactions, group accounts, and automatically generate financial reports. During an accounting period, many transactions are recorded in each account. Both debit and credit entries accumulate over time. Let's take an example of an asset account, such as inventory. When the company purchases new items, the value of that asset increases and the amount is recorded on the debit side of the account. When the company sells or disposes of products, the asset decreases and the amount is recorded on the credit side. At the end of the reporting period, we can calculate 2 important values for the account: debit turnover, which is the total of all debit entries recorded during the period, and credit turnover, which is the total of all credit entries recorded during the period. Using these totals, we determine the account balance. This remaining amount in the account is called the balance. Balances can be an opening balance, which is the amount at the beginning of the period, and a closing balance, which is the amount at the end of the period. For asset accounts, the balance is normally debit because assets represent resources owned by the company. A company cannot normally reduce an asset below zero. It cannot dispose of more resources than it actually owns. For liability and equity accounts, the balance is normally credit because these accounts represent the sources of financing of the business. As you may have noticed, the total balances of debit accounts must always equal the total balances of credit accounts. This happens because every transaction is recorded twice, once as a debit and once as a credit. This system ensures that all business events are properly recorded and that the accounting system remains balanced. If, at the end of a period, total debits do not equal total credits, it means that something is wrong in the accounting records. A transaction may have been entered incorrectly or an entry may be missing. This internal balance is one of the key control mechanisms in accounting. However, accounting does not exist simply to add and compare numbers. The ultimate goal of accounting is to produce financial statements. These reports provide valuable information to different groups of users, such as government authorities, investors and lenders, and business owners and managers. Financial statements help them understand the financial position of the company, evaluate performance, and make informed decisions. The main financial statements include the statement of financial position, the income statement, and the cash flow statement. The statement of financial position, often called the balance sheet, shows the company's financial position at a specific moment in time. The income statement shows the company's performance during a period. The cash flow statement explains how cash moved during the period. As you can see, accounting is a universal and standardized financial language. We hope this video helped you gain a basic understanding of how accounting works. See you in the next lesson at AccountingSuite Academy.